Thanks for tuning in to the second episode of the Opal Dividends Podcast. I'm Austin Graff, and my co-host is Adam Muller. Adam, what do you think about earnings as we make our way through fourth quarter earnings?
Yeah, it's a busy time of year, right? With you get the fourth quarter, you get the whole year numbers, so you can plug those into your models and forecasts. And despite being a long-term investor and not really being concerned with any particular quarter, I think given the environment we're in and all the different macroeconomic factors that are influencing markets, I'm probably paying attention to this earnings season more than I have in a while. Specifically listening to the management commentary about what they're seeing around the issues like inflation and growth and demand and supply. So it's really it's a transcript heavy time of year, and it's interesting to listen to management talk about things that doesn't quite seem like the market's reflecting.
Are there any trends that you've kind of witnessed or focused on as we get through? I think we're a little over 3/4 of the way through earnings so far.
Yeah, well, it's interesting. It's interesting to me that it feels like more companies are kind of meeting their earnings estimates than I would have thought. But it also feels like they've done a wonderful job of guiding those down over the last 6 months. So they're meeting estimates that would have been significant misses if it was 6 months ago. And then the market is kind of rallying in the background around that information, which is sort of an interesting dynamic.
It is kind of unique how you see the management teams walk down analyst estimates and then they miraculously beat by a penny or two, and everyone gets excited because they beat. And then we have kind of management teams walking down estimates for 2023 already, and it's kind of just a rewind of what's been happening, and you could see how that could be like a circular downtrend. But the market seems to be getting kind of excited about it as they announce these numbers. I guess in the short term, people are just focused on, did they beat or miss on these estimates that have been revised down. I guess with that in mind, let's move on to something a bit more excited, which is corporate layoffs. Do you have any views on all these announcements of corporate layoffs?
Did you just describe that as something a bit more exciting? That's an interesting way to talk about layoffs. But look, I think that actually ties nicely to the earnings discussion, right? Because companies are getting rewarded when they get on their earnings conference call, regardless of what the numbers were, and saying, we're going to restructure and we're going to take X $100 million or X $1 billion out of the cost structure in the next 24 months. And we're laying off 7,000 people. We're doing this, we're doing that. And then the stock is up 5% in the pre-market, simply because they're being rewarded for doing something. And it's interesting because it's not about growth. It's not about a new product cycle or driving demand. It's about the market's fear that margins are going to get compressed. And what can you do about that and getting ahead of it with cost cuts, which include, in a lot of cases, layoffs. That said, the macro job data suggests that the job market is still incredibly tight. So there's a bit of a disconnect between these layoff announcements and what actually seems to be happening.
Yeah, it's really confusing. I think if you're actually paying attention to try to figure out what's going on, I think the best explanation that I've seen out there is we have a lot of tech companies primarily. I guess some of the blue chips are starting to lay off white collar workers in some smaller amounts, but they're laying off these workers and then they're finding their way to kind of smaller enterprises, which have had a really hard time. So it's a really unique situation where we're seeing these layoffs in the headlines, but then it's not really showing up in the unemployment or in the wage data. So it's really confusing from, I guess, an investor to try to understand where things are going from here. So I don't know. I
think, was it Jolt data that says there's 1.9 job openings for every person who's unemployed? There's still 12 million job openings. I might have something absurdly high, and the jobs data for last month, which was, I think, came out last Friday, was 500,000 and some odd job creation, and yet we're almost a year, well, we're probably 10 months into a Fed tightening cycle. that is supposed to squeeze down demand. So what exactly is I think there's just a lot of uncertainty about which way this thing's going to go, which leads to volatility, and volatility doesn't just go down, right? Volatility also goes up, and maybe that's what we've seen in this market rally to start 2023.
Well, it's also, I guess they look like big numbers too. If you look at, whether it be Alphabet or Amazon laying off thousands of people, but when you look at the employee base from where they were in 2019, it's not even close after the layoffs to where they started. So you got to think they have to right size the labor force at each of these companies at some point, as they don't see the growth that they expected coming out of 2020, 2021. So I think it's just a unique situation. We might be seeing some power in the market going from some of the big tech companies to smaller companies because they have the willingness and desire to hire, but also power going from employers to employees a little. We've seen labor negotiations with some of the unions be really, somewhat challenged. So it could be an interesting time just to watch this play out, and we might see that pendulum swing back in favor of the employee a little bit. I guess with that in mind, maybe we could talk about something that's actually more exciting, which is the market rally. What are your thoughts on the market rally so far in 2023?
I mean, if you had asked me in December if the market would be up significantly in January, I would have probably said I don't see why it would have been. And if you ask me today why it's up in January, I would say I'm not sure. Maybe it's that things aren't as bad as people thought. The recession fears have maybe subsided a bit, or the belief that the Fed could engineer a soft landing has increased, that might actually happen. But it still feels like the market's earnings in 2023 are still going to be challenging, and the multiple that it's being ascribed to it right now feels a little robust. But maybe people are feeling just a little bit better, and that's been reflected in the stock market. And the money has to go somewhere. And if you're not going to keep buying bonds, where does the cash go?
Well, people did start buying bonds, right? The interest rates went down. I think that could be the biggest argument for the rally from a fundamental perspective, right? Because if your discount rate goes down, your net present value, your cash flows theoretically goes up after a year when that net present value, or that interest rate went much higher than most people expected.
Things just sell off too much at the end of last year.
Yeah,
right? What's gone up? It's been the garbage. It's been the stocks that suffered the most in 2022 that have rallied the most in 2023, including names that everyone knows, like a Meta, right, and some of the other technology names and things. So maybe it was just, everyone sold these things off because they thought rates were going to the moon and there was going to be a deep recession. And now when people are like, well, maybe there'll be a mild recession to no recession at all, and rates have calmed down, so we want to buy these back now.
I think you're being too rational. The dash for trash is like, you look at this. I think there were some numbers in Barron's last weekend that something like the top 10% of most heavily shorted stocks are up over 33% year to date. Wow. And the top 10% of stocks that were down the most in 2022 are up nearly 40% year to date. So it really seems like instead of coming up with some miraculous fundamental reason for things happening, it's probably just a technical issue, because the actual fundamentals don't seem to be driving these share prices. So when you're looking at technicals, I'm always, being a fundamental analyst, I'm always a little leery of the technicals. And what is it, double golden cross or something right now? I'm always a little leery that that's going to hold out, because it's unclear what's actually driving that change. And if there
double golden cross is also my stripper name, by the way. But we can edit that out. But go ahead.
I know you stopped me in my tracks there. So maybe we should move on to the Federal Reserve comments. Any thoughts?
Well, that ties into this, right? Because the last Fed meeting, they raised by 25 basis points, which is what everyone expected. So there was no surprise, which is what the market likes. Doesn't like surprises. And then all the comments from the Fed, both in the conference call associated with the Fed meeting, but also from in at least one speech since the meeting where people thought they might walk back their dovishness. Instead, they kind of just doubled down on it's starting to work and we're getting towards the end of the hiking cycle, which is all the bulls need to hear to start, pouring into the stock market.
Yeah, I think it's an interesting interpretation, right? It seems like everyone wants the Fed to walk back, this expected decline in interest rates in the back half of 2023. And for the Fed to actually do that, they have to contradict their view that they're data dependent, right? Because the only way for them to say, hey, we're not going to be reducing rates in the back half of 2023 is to say, hey, we're going to ignore the data between now and July or August. And we're just going to tell you that the data doesn't matter. And so what they are saying to try to maintain, I would say some bit of credibility, if they do have any credibility left, is they're just saying, hey, we expect rates to be higher for longer. And the market's like, well, they didn't say that they don't believe where rates are. So we must be right. And the rally powers ahead. So I think it's an interesting, box that the Fed finds itself in, because they're trying to be more transparent, but they're also trying to be true to their kind of comments that they're data dependent. And you can't necessarily achieve all the objectives of tightening, of creating tightening monetary conditions because of the fact that, the market seems to be disagreeing with them.
It's interesting to me that you read like the I'm going to say academics. I'm not sure that's quite the right bucket, but the academics will talk about it can take a year for Fed interest rates to actually have kind of an impact on demand in the economy, which is the intended effect. And I think they started, as I think we mentioned earlier on this podcast, they started raising, I think, in April 2022. So we're not quite at a year. We're 10 months in, and they're talking about, well, it's working, and we're towards the end of it. And that begs the question, like, how do you know? Like, do we, so to your point exactly, is that there needs to be more data. I think you need maybe another 3, 4, maybe even 6 months. And then that impact of the very quick tightening cycle could squeeze demand more than you ideally would like, which tends to happen because you can't be precise on these things.
Well, you're a resident academic, right? How many master's degrees do you have?
Well, it's really the glasses that really make me.
I thought it was the jacket.
Jacket helps. But yeah, it'll be. I mean, I think the data will be what it is. Like, no, we don't know what the data is going to be over the next few months. But right now, things look pretty good.
Seems like tighter for longer, right? Like the economy seems pretty strong. If you're looking at labor as one of the issues, aside from some headlines that seem to be coming out, the actual underlying data seems to be pretty strong. So I guess moving on to our fifth and final topic, what do you think about this buyback tax proposal, taking the newly instituted 1% buyback tax up to 4%?
I mean, it's interesting because it doesn't feel like the 1% buyback tax has had an impact on corporate behavior. You've still seen a lot of buyback announcements. Nothing in the numbers suggests that was something that pushed companies to either return the capital through dividends or invested in internal projects, which I assume is the intent of the tax was perhaps one, to raise a little bit of tax revenue, but more importantly, to have some sort of influence on corporate behavior. So to that end, it doesn't feel like it's worked at all. But now that it's there, it's easier to go from 1 to 4 than it is to go from 0 to 1. 1 year increasing at 4x, the other is an infinite increase because it didn't exist before. So I don't know if 4 is some sort of magic number where people will be like, whoa, that's a little expensive. Maybe we won't do buybacks. Because some companies have to do buybacks because of stock compensation, right? And their share counts will start to increase, and that'll hurt earnings if they don't do the buybacks. The alternative, of course, is paying dividends.
Really, pay a dividend? How do you compare that? I mean, it seems like I think the argument's always been that dividends are a less effective form of capital allocation because of the tax treatment, right? Like dividends got taxed at 15 to 20%, depending on how much money you make. And if technically a company didn't have to pay taxes on their buybacks, then, theoretically you're getting more bang for your buck with a buyback. I think that's great in kind of the laboratory of academia where people are buying back shares at attractive values. But what happens more times than not is management teams buy back stock when they have cash. And that often tends to be a time when stock prices are high. So they buy back more stock when prices are high, and they buy back very little stock when prices are low. And so it kind of negates the tax benefits. And as we see that tax benefit dwindle, I do think there will be some preference moving from buybacks to dividends, in my opinion.
Yeah, I think I think you nailed it, right? Because buybacks are effectively impossible to do right. Theoretically, they could be terrific, and every once in a while, a company probably gets lucky. But the reality is that when your stock price is down, it's because something's gone wrong, either in the economy or with your business specifically. And what you need to do is hoard cash to survive whatever the issue is. But in hindsight, that's exactly when you should have been buying back. When everything's rosy and great, prices are inflated, valuations are up, and you have excess cash, so you buy back shares. And over time, you're just destroying shareholder value, whereas your intent should be to create it. You're much better off creating a greater tax burden on your shareholders to some degree, but just paying a steady growing dividend that you size so that you can grow it through the cycle as your business, does what it should be doing.
It's more of a moral contract too, right? Like if you're paying a growing dividend, you're going to be more, efficient in your capital allocation because it's very kind of transparent what you're paying and when you're paying it and how much you're paying.
Sure.
So you don't see many big dividend payers talking about moonshot projects and stuff like that, which I think for most shareholders in a non-zero interest rate environment would look at as a stupid use of money, and they'd rather, have it themselves for their own, allocation purposes. So it's an interesting dynamic. I'm really interested to see how it plays out because just in the last few days hearing about this, I think the biggest, talking to clients, the biggest pushback has been, well, will it get through the current Congress? And I believe if there's any tax that's going to get through this, opt-in tax is something that would have the best likelihood.
Well, it's interesting because I wonder if it could push some companies on the margin to take the approach that some companies do already, where you pay a smallish but steady dividend, and with some sort of kind of rule-based system where at the end of every some period of time, you take excess cash flow and return it to your shareholders in the form of an annual special dividend or something to that extent. So the special dividend can vary every year depending on how the business is performed. But there's also the underlying kind of base dividend that is, a sort of a smaller, but hopefully, growing dividend over time. And you see that in some commodity businesses, right?
The Costco special, they do that all the time, right? They have that
Costco, okay, yeah.
At the end of the year.
Yeah.
Yeah.
And that might end up being like an easier way to approach it if you're worried about this dividend tax, or if dividends somehow the buyback tax. It's weird to me that share buybacks are becoming like a political issue. But it's the reality. It's
a compensation issue. You brought it up when you started, right? You're talking about dilution due to the fact that people are paying, their employees a lot of money in shares. And in reality, what's going on is you have a lot of technology companies that were compensating employees in the form of shares, right? Or RSUs, options, whatever you want to call it. They're handing those out as a way to boost or juice compensation, which works great when stocks are going up. But when stocks are going down, employees get upset because they're not making what they thought they were going to make. And ultimately, companies end up topping those up, right? So it's kind of like heads I win, tails I win from the employee's perspective. And then the shareholders just get kind of screwed over because the share count goes up even more when the company has to go in and top up their compensation because they're issuing shares at a much lower price. Like it's not like an employee is going to be like, yeah, I'll take a 50% drop in compensation because the share price is down 50%. So I think there is some valid argument here. I just don't know that Washington's going to get it right. I think shareholders.
I knew stock compensation would be the thing that got you fired up. I haven't seen you that emotional since the Blue Jays lost to Texas in the playoffs in 2016. It was also your wedding, but I think it was really the Blue Jays situation that got you emotional.
I didn't get married in 2016, so.
Okay, 15?
It's 2015.
Okay, I was off by
On that note, I guess we better wrap it up. Thanks for joining us for the second edition of the Opal Dividends Podcast.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital, LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.